Public finance. The federal government helps prevent market failures by overseeing the allocation of resources, distributions of income, and stabilizations of the economy. Regular funding for these programs is secured mostly through taxations, borrowing from banks, insurance companies, and the governments, and earning dividends from its companies. Also helps finance the federal government. State and local governments also receives grant and aid from the federal government. Other sources of public finance include users charged from ports, airport service and other facilities, fines resulting from breaking laws, revenues from license and fees such as for driving and sales of government securities and bond insurance. Second, corporate finance. Business obtains financing through a variety of means ranging from equity investment to credit arrangements. A firm might take out a loan from a bank or arrange for a line of credit. Acquiring and managing debit properly can help a company expand and become more profitable. Startup may receive capital from angels, investors, or venture capitalists in exchange for a percentage of ownership. If a company thrives and goes public, it was issued shares on a stock exchange. Such an initial public offering bring a great influence of cash into a firm. Establishing companies may sell additional shares or issues corporate bonds to raise money. Business may purchase dividend paying stock, blue chip bond, or interest breaking bank certificates of deposits. Personal finance. Personal financial planning generally involves analyzing an individual's or a family current financial positions, predicting short-term and long-term needs, and executing a plan to fulfill those needs within individual finance constraints. Personal finance depends a lot on one's earnings, living requirements, and individual goals and desires. Matter of personal finance includes but are not limited to the securing of financial products like credit cards, life and home insurance, mortgage and retirement products, personal banking such as checking and savings accounts, individual retirement accounts is also considered to a part of a personal finance. Social finance. Social finance typically refers to investments made in social enterprises, includes charitable organizations and some cooperatives rather than an outright donations. These investments takes the form of equity or debit financings in which the investor seeks both a financial rewards as well as a social gains. Modern form of social finance also includes some segment of microfinance, especially loans to small business owners and entrepreneurs is less developed countries to enables their enterprises to grow. Lenders earn a return on their loans while simultaneously helping to improve individual standard of living and to benefit the local society and economy. Behavior finance. There was a time that when the theoretical and empirical evidence seemed to suggest that conventional finance theories were reasonably successfully in predicting and explaining certain type of economic events. Nonetheless, as time went on, academics in the financial economics realms detected anomalies and behaviors which occurred in the real world but could not be explained by any available theories. It's become increasingly clear that conventional theories could explain certain idealized events, but that the real world was in fact a great deal more messy and disorganized, and that make participants frequently behave in the way that are original and thus difficult to predict according to those models. As a result, academics begins to turn to cognitive psychology in order to account for irrational and illogical behaviors which are explained by modern financial theory. Behavioral science is the field that was born of these efforts. It seeks to explain our actions, whereas modern finance seeks to explain the action of the idealized.